Welcome to this week's Market Update, where we review the key developments that shape markets, highlight what drove our recent performance, and look ahead to important events on the horizon. Let's start with what moved markets. The big picture remains encouraging: a resilient US job market and accelerating investment in AI. The labor market stayed on solid footing, with the initial jobless claims easing to 226,000 and employers adding a better than expected 172,000 jobs in May. This matters because steady employment supports consumer spending, which is the largest driver of the economy. For our portfolios, a resilient job market reinforces corporate earnings and eases concerns about a slowdown. Next, we have the AI story, which is increasingly becoming an infrastructure story. Federal regulators this week announced steps to speed up connecting large data centers to the power grid, potentially cutting approval times from years to just a few months. This opens opportunities well beyond just technology, including industrials, utilities, and infrastructure, a powerful long-term theme in our portfolios. Finally, major technology companies are investing aggressively in their future. Firms like Alphabet, Amazon, Meta, and Microsoft are redirecting capital from share buybacks towards AI and data centers, investing at record levels today. Markets have so far responded positively, recognizing that today's spending can drive tomorrow's revenue, productivity, and competitive advantages. Now let's look at what drove our performance and why we remain confident in our positioning. Honeywell was our top performer with an over 11% gain, supported by optimism around its planned aerospace spin-off and a focus on simplifying its business to unlock value. With strength in automation, industrial software, and aerospace, plus a solid balance sheet and an attractive valuation, Honeywell is well positioned to keep executing. The financial sector led our performance with a 0.95% contribution, powered by major banks and capital markets firms like Goldman Sachs, Morgan Stanley, and JP Morgan, along with Canadian leaders TD and Royal Bank. These businesses are benefiting from a healthy credit, active deal making, and expectations for gradually lower interest rates. We remain focused on industry leaders with strong balance sheets. Our size strategy was the week's strongest performer, with a 1.15% contribution, as large established companies outpaced smaller peers. Giants like Nvidia, Tesla, Caterpillar, JP Morgan, and Alphabet led the way. Investors continue to favor businesses with the scale, financial strength, and resources to invest in trends like AI and automation, exactly the kind of leaders that we hold. Looking ahead, here are the key events that we're watching in the week to come. Monday will bring Canada's latest inflation report. The most recent reading was encouraging. Headline inflation ticked up to 2.8% on higher energy prices, but came in below the 3.1% markets had expected, while the Bank of Canada's core measures eased to their lowest level in 5 years. Signs that underlying inflation is cooling keep the door open for gradually lower interest rates. Thursday brings the Federal Reserve's preferred inflation gauge, that being the core PCE index. The latest monthly reading rose just 0.2%, which was below expectations even as the annual rate held at 3.3%. A cooler monthly pace supports the case for the Fed to eventually ease policy later this year or early next year. Thursday also delivers the final reading on first quarter US GDP, which came in at an annualized 1.6% previously, which was a step up from the 0.5% the prior quarter. Led by strong business investment, steady growth alongside cooling inflation, all are encouraging combinations for both earnings and markets. As always, we remain focused on helping you reach your long-term goals through disciplined investing. Thanks for joining us, and we'll see you next week.